Wealth is the transfer from the impatient to the patient. I want to speak with you today about one of the simplest, yet most often ignored, truths in the entire financial world. It is the undeniable advantage of the long-term investor over the short-term trader. This isn't a matter of opinion. It is a matter of mathematics, psychology, and the fundamental nature of business itself. The stock market can often feel like a casino, a place for quick bets and rapid action. But this is a grand illusion. For the intelligent individual, it is not a casino at all. It is a marketplace where you can buy part ownership in some of the finest businesses on earth. And the real magic, the true engine of wealth, is not found in rapid buying and selling. It is found in the patient act of holding. Let's begin with the most powerful force in the universe that is on the side of the long-term investor: compound interest. Compound interest is not a complicated concept. It is simply the process of your earnings generating their own earnings. It is a snowball rolling down a very long hill. At first, its growth seems modest, almost insignificant. But as it continues to roll, gathering more snow with each revolution, it grows from a handful of snow into an unstoppable avalanche. The short-term trader stands at the top of that hill, constantly stopping the snowball, breaking it apart, and trying to start a new one, hoping the next patch of snow will be better. He interrupts the most powerful part of the process. The long-term investor, by contrast, does one thing. He gives the snowball a gentle push and then gets out of the way. He lets the natural, relentless mathematics of compounding do all the heavy lifting for him. He understands that time is his greatest ally, not a pressure to be managed. Now, let's talk about the enemy of the short-term trader, which is a friend to the long-term investor: taxes and costs. When you are a trader, every successful trade is a taxable event. You are handing over a significant portion of your gains to the government each and every year. This is a relentless drain on your capital. The long-term investor, by holding his investments for years, defers those taxes far into the future. This means that money that would have gone to the government continues to work for him, compounding inside his account for decades. It is an interest-free loan from the Treasury that supercharges his returns. And then there are the silent killers: fees, commissions, and the bid-ask spread. Every single time a trader buys and sells, he pays a toll. These tolls may seem small individually, a few dollars here, a few cents there, but over hundreds of trades, they add up to a torrent of money flowing out of his pocket and into the pockets of brokers and market makers. The long-term investor pays these tolls only a handful of times in his life. He is not feeding the croupiers, he is keeping his chips on the table. But the most profound advantage is not mathematical, it is psychological. The short-term trader is engaged in a constant, exhausting battle. He is not competing against businesses, he is competing against other traders. He is pitting his wits, his emotions, and his limited information against some of the fastest supercomputers, the most brilliant quantitative minds, and the most well-funded institutions on the planet. It is a game where the odds are stacked overwhelmingly against him. He is trying to outguess the market, a task that is not just difficult, but fundamentally impossible over the long run. This constant battle creates a state of perpetual stress. The trader is a slave to the ticker tape. His mood swings with every point the market moves. He is driven by two of the most powerful and destructive emotions in investing: greed and fear. Greed pushes him to chase a rising stock, and fear forces him to panic sell a falling one. He is, in essence, buying high and selling low, the exact opposite of what he intends to do. The long-term investor is liberated from this tyranny. He understands that the daily, weekly, or even yearly fluctuations of the stock market are meaningless noise. The market, in the short term, is a voting machine, tallying up which companies are popular or unpopular that day. But in the long term, it is a weighing machine, accurately assessing the true value a company has created over decades. Because he knows this, the investor can look upon a market crash not as a catastrophe, but as a fantastic sale. While the trader is panicking and selling, the investor is calmly asking, are the businesses I own still fundamentally sound? Are they still selling products people want? Are they still profitable? If the answer is yes, he may even use the opportunity to buy more. He is not betting on the mood of the market. He is investing in the progress of the business. Think of it like this. If you owned a farm, would you get a new appraisal on your property every single day? Would you panic and sell the farm because a neighbor offered you a low price one Tuesday in a rainstorm? Of course not. You would care about the long-term fertility of the soil, the reliability of the rainfall, and the health of your crops. You would think in terms of seasons and years, not hours and minutes. The stock market is no different. When you buy a stock, you are buying a fractional interest in a real business. The intelligent thing to do is to care about the long-term fertility of that business, its products, its management, its competitive position, not the daily price quotation that a fickle market offers you. The goal of the short-term trader is to be clever. The goal of the long-term investor is to be wise. Trading is an exercise in activity. Investing is an exercise in patience. Trading is a test of your IQ. Investing is a test of your temperament. The evidence is overwhelming. The vast, vast majority of day traders lose money over time. Meanwhile, the entire history of the American economy is a story of long-term upward progress, and those who have simply owned a diversified portfolio of high-quality businesses and held them through the inevitable storms have been richly rewarded. Your path to financial success is not complicated. It is not about finding a secret formula or a complex algorithm. It is about making a few sound decisions and then having the fortitude to sit still. Buy shares in wonderful businesses that you understand at reasonable prices. Do this not with money you will need next month, but with savings you can truly put away for the long haul. Then let the managers of those businesses go to work. Let them innovate, let them grow, let them generate profits. Reinvest those profits. Let the power of compounding begin its slow, silent, and magnificent work. Ignore the noise, tune out the pundits, turn off the financial news. Your greatest asset is not your ability to predict the next market move. Your greatest asset is your ability to resist the urge to try. In the long run, the stock market is a mechanism for transferring wealth from the active to the patient. Make sure you are on the right side of that transfer. Be an owner. Be patient. Be wealthy.